Welcome all to the Node. My name is Mike, aka Veteran Crypto, and we come to you at 9 a.m. Pacific time and noon on Eastern time, Monday through Friday. And we bring you crypto news, TradFi news, DeFi news. We also get great interviews. We've done a couple so far and have a couple coming up that I think you'll all be excited about. And if you would please like, follow, and share the stream. While we're waiting for David to join us, let's go ahead and jump into where you can find us. So let's do the socials real quick. So if you want to join the conversation, here on YouTube, in the chat, ask questions, correct us if we're wrong on something, please, by all means, we're not an echo chamber. Come on over at the Node Network, all one word. And this is where you can find all of our shows. So you can see, we're live right now. Trump's World Liberty Fi defends FUD. Tonight at 6 p.m., we're going to be doing our Red Pill show, which tonight we're going to be talking about incentives versus intentions, why men are winning by opting out of marriage. So we're just going to talk about the topic of why so many men these days are opting out of getting married, and for the most part, opting out of dating. I'm one of them. So I'll definitely be speaking from that point of view. We're still looking for, ladies. We're going to have a respectful conversation, but we're still looking for single ladies that want to share their dating experiences, and kind of, from their point of view. We're all about, having, the full conversation here. We also have Crypto and Chill on Tuesdays and Fridays with myself and Jeff at 5 p.m. Pacific, where we just relax, kind of hang out, talk to each other, and talk about life in general, and then also talk a little bit about crypto, but basically just kind of what's happened over the day. So this is kind of beginning of the day, that show, and a couple of our other shows are towards the end of the day, just to kind of bookend the everything that goes on. Jeff has his own show called The Blockchain Report, Monday, Wednesday, and Thursday, immediately after this show. And this is where he does deep dives on new projects, and often projects that you can airdrop farm. So that's something, if you're interested in diving in on that. Sovereign Soil. This is my solo show that I do, and every once in a while, Drew from Blockchain Basement joins me. But I've been into emergency preparedness and homesteading for quite some time now, and actually a couple of decades. And so, this is kind of where I'm sharing my experience with everyone out there that is interested in being a little more prepared for emergencies, or if you're looking to homestead, if your dream is to move off grid, have a garden and livestock, and just kind of try to live a more sustainable lifestyle. That's kind of what we're about here, and not just from homesteading, but also with crypto and finance is becoming more self-sufficient. So let's see what else we got here. We got the market wrap. So David, at the end of the day, he does a market wrap where he goes over charts. So it's usually about 15-20 minutes of nothing but charts, where he just goes over kind of what happened that day in the macro of what's moving the markets. So if you have a project that you're interested in, and want him to go over that, take a look and give you some TA on your project, that's a great time to tune in. And that's 1 p.m. Pacific, 4 p.m. Eastern. And on Tuesdays and Thursdays, he's actually started doing a one-on-one coaching live immediately after the market wrap up with Ellie, who's in our chat right now, a long-standing member of our community. He chose her to demonstrate his coaching program. He's helped over 400 different individuals. It's a very intensive, very customized. I started using the word bespoke experience. How's it going, David?
I'm doing well, Mike. Doing well, thank you. Yesterday, man, I had to go see a doctor, and they diagnosed me as being fucking amazing. So I'm awesome. Unfortunately, it's terminally awesome.
Man, so you're gonna die of being awesome?
I guess so, man.
All right, all right. So the prognosis is both good and bad, I guess.
I guess so.
All right, and so then we got Jeff has Saturday Night Fever. So if you're into like DJ music, things like that, mixes, he does a lot of. He started doing some really cool interviews, and they also do tutorials. So if you're aspiring to be a DJ and want to know how it's done, great show to tune in for. He's been doing done pretty solid sets that I've watched. So I always enjoy tuning in for that on Saturday nights. The Red Pill tonight, like I said, we're going to be talking about, and I'm sure David will probably join us as well. He's a single guy, and then Jeff, he's also a single guy. And so, we're going to have some other people show up, but that's basically going to be the topic: is the incentives versus the intentions of and why men are opting out of dating, and and a lot are opting out of marriage and having kids, just because of different aspects. So we're going to go over that tonight. If you know any single ladies that are willing to come on, I would love to hear their point of view on the topic. I've been all over social media, sending out invites, anybody that's willing, but have yet to have any takers yet. So, gaming and chill. So, Ellie in the chat and Jay, another community member, they have started doing a live show on Wednesdays and Sundays at 6 p.m. Right now, they've been doing Arc Raiders. Yesterday, I started a game that I bought a while back that finally went live. Is a Windrose. It's a pirate game, and so I started going live with that yesterday. So just another channel here on the network. So we got gaming, we got controversial topics, we got music. David's getting ready to launch anytime a live show isn't going on, we're going to have a live stream of music, and it's going to be AI generated custom music. And we got markets and TA, we got DeFi, education, we got a little something for everybody here. So anything to add on that, David?
It's a lot of fun. That's what I'll add. If you just kind of want to learn and have fun, I think the Node is the place to be.
Yeah, no, it really is. And we, pretty much everything here is at no charge. A lot of other channels, and a lot of other content creators, they gate everything, to where you got to pay for additional aspects, or different services and things like that. Most of the stuff that we have, we offer at no charge, because we want to show you that what we create is valuable. And then, the stuff that we'll go over here in a minute that we do charge for is, just in add-ons, if you want to take it to the next level. So, it's like getting the car for free, but, getting upgraded wheels and interior, then you got to pay for that. So
you got to get the upgrade packages.
Yeah, with 2 Ds for a double dose.
That's right.
All right. So if you want to find us over on X, it is at the Node Channel, all one word. And last but definitely not least is our official website, thenode.pro. And this is what David has been building out. We're getting closer and closer every day to it being finished. And this is truly the node of the node. This is where you can find everything of that is us. You can find the live streams, you can find the chat, you can find all the different news that we talk about here on the show. It's hyperlinks so that you can read in depth. Sometimes we don't have the time to go in depth on every single thing we talk about, so we give you the links so you can do your own research. We're not here to spoon feed you. We're here to give you the macro, and it's up to you to go in for the details. You got DeFi University. This is yet another high value resource that is no cost. All you got to do is go and start taking the courses, taking the quizzes. It's all very professional, very structured. Walks you through each lesson, builds on previous lessons. With checks on learning. I can't stress enough that this is something I was looking for when I got into DeFi and could not find. Everyone out there charges for this stuff. We're the only one that I've found that offers it for free. So, sorry, at no charge.
At no charge. Yeah, I
So,
mean, it
okay.
really it's just up to you, like, how bad do you want it? Do you
Mhm.
want to build a skill set? Do you want to understand what it is that you're doing when you operate in crypto and DeFi? If yes, well, then all the education is out there. The information doesn't cost anything. It's really just learning how to implement it. And, again, how bad do you want it?
Exactly. No, and that's if you are investing money into these markets, why are you not investing in yourself? In your skill sets. It's like going to the range, not learning how to shoot, and just blasting off a bunch of ammo that cost a bunch of money. You're not getting anything out of it. You might get a little excitement out of it, but you're not accomplishing anything. So, just like with shooting, find somebody like us, like David, I should say, that is super knowledgeable, that has put together this educational material, a subject matter expert. Learn just like you would, like if you came to me for shooting, you know, find a subject matter expert and have them teach you so that you can avoid the mistakes that a lot of us made when we were learning that are very costly, mind you. So there's also the private coaching that he's again is taking Ellie through on Tuesdays and Thursdays on the daily market wrap up, and that is that one-on-one, very involved, very customized offering that David does, and that is something that we charge for. So, but again, very time intensive. It's very customized for each individual. It's not a cookie cutter service. So very important. The AI newsletter is about to launch. That is unlike anything I've seen out there. I currently put out a newsletter, but that's something that I put together, and it is the usual suspects: Bitcoin, Ethereum, Solana, pretty much what everybody does. But the AI newsletter is going to be fully customizable. You are going to be able to pick the assets you are interested in, and not just crypto. You're going to be able to do stocks, commodities, anything that has a ticker. You can put it in there, and it will generate a newsletter tailor made for you. That is going to give you the trading ranges for your assets, and it's going to give you the social media posts with hyperlinks to those posts about your assets, of what's going on. It's going to give you liquidity pool ranges for your assets in case you want to get into a DeFi liquidity pool. It's going to give you news with hyperlinks, so that you can read articles that are for the assets that you are interested in. And it's a simple click. You click choose the assets, click generate, go make a cup of coffee, a cup of tea, come back, and when you come back, it's waiting for you. 5-10 minutes, you have your finger on the pulse of what's going on with your assets for the day. You can go about your day. The newsletter usually takes me about an hour, 45 minutes to an hour. With what this one is going to give, it would probably take me about an hour and a half to put it together. So it's a huge time saver, and it's only $20 a month, 66 cents a day. It's what is your time worth? So, and then of course you got our community tab where you can join, DeFi University, and you can again, no cost, and at no cost you can join our Discord and talk to a community. We have people that join all the time. We have probably about 400 or 500 people in there now, and it is a place that you can ask questions. If you have a question about DeFi, if you have a question about a project, if you have news that you want to share, we have people that shared all of our community that shares social media posts or news articles that they find. So it's a really great community. We have great mods and admins that keep it clean. Make sure that scammers get almost immediately booted. So it's not like a lot of discords. There's almost no scamminess in it whatsoever because we just immediately weed them out. So I think that's it. Did I miss anything, David?
I don't think so, Mike. I think you got everything. We talked through all of the course material. In fact, you might even want to just show that off because it's pretty darn cool. If you click on that course tab there, all of the educational content that we've built out here and that we give away to everyone who wants it.
See,
that
there's that F word.
Ah,
Here, I'll zoom in. There you go.
yeah,
See,
there it is.
there's that F word.
Yeah,
So,
so
okay.
if you take a look at some of this content, if you just click through to one of the lessons, every single one of these lessons has a podcast that you can listen to. People learn in different ways, right? So
Mhm.
you've got a podcast you can listen to. You can play the video overview. You can go through their pretty pictures. Like
Dude,
if you like
honestly,
looking at
I know it's
pictures.
silly, but I'm very visual. I'm a visual learner. And so if I can see like a graphic that explains, what's being, taught, then it helps me absorb the information.
Yeah, I think many people are visual learners, and in crypto and DeFi, though, you have to learn not just by reading about something, but you got to learn by doing. So after you read through a lesson and then watch the video overview and listen to the audio podcast, well, then there's an exercise, and so every single one of these lessons has an associated exercise. And then once you've gone through and completed the lessons and the exercises, you can take some quizzes. So yeah, there's quite a lot of content here, and this is just one course. There's
Mhm.
15 courses in the node right now, and
Yep.
still working on the last five. I think that's going to be one of the last things that I do. Just want to make sure that newsletter works, get
Yeah.
all of our AI agents working for us. They're all framed out. So now it's just a matter, literally, of giving them keys and telling them to go. Time for them to go and do.
Yeah.
So it's kind of
Go and do.
it's kind of honestly, Mike, it's kind of unsettling a little bit because giving these agents API keys so that they can go and do work for us. Um, well, if they've got the keys and they can do good work for us, that means that they could also make mistakes. So it's going to be a great learning experience to see these agents working for us. But we're very, very close, man. Very, very close.
Dude, I'm so excited. It's just this has been a long time coming. I mean, almost 2 years now. This October will be 2 years since me and Jeff started DeFi crypto and airdrops, and and then of course we rebranded once we teamed up with you, and so yeah, I mean, basically this has been a very long time of putting in like sweat equity and a lot. And I know that you've done a lot of sweat equity, building out DeFi University and all of that. So just this coming together of the community and the material is just a perfect match.
Yeah, I think so. You got to have the educational material because when people show up who are new and they want to build a skill set and really learn about this stuff,
Yeah.
you don't want to have disparate resources all over the place. Like, you watch some content on YouTube and then you go to X and you see some post, and then maybe you
Mhm.
go to Google and you find something on DeFi Llama, and you try to weave this all together. And when you're just starting out on your own, it can be really, really challenging to know what to trust, know what to believe, know which information is.
Oh,
So, that's why I put all this stuff together in the educational material like this. And, I'm sure that there are a lot of people who get value from it.
oh, absolutely. Well, I mean, like I said, I know of, I can name a couple of channels. I won't, but I can name a couple of channels out there that are charging hundreds, if not thousands of dollars for programs that honestly, from what I've seen, offer less. So, I mean, if you want to go pay, go ahead and do that, but we offer it at no charge. So,
Yeah,
with
so Mike, Elon Musk was talking about this just yesterday, actually, or maybe it was the day before. He was talking about educational material essentially being at no cost now, because the internet made information ubiquitously available to everyone on the planet who wants it. So it's really just up to you to find the info. And, all I've done is put everything in one place.
yeah,
All the crypto and DeFi information about Bitcoin, Lightning, Nostr, all in one place.
well, I mean, that's pretty much all education is, if you're paying for it, you're paying for somebody's time that, like even at a college, you're going to, be taught by somebody, they're paying a professor to teach you, because they went out and learned, through life and, experiences and, going through their, courses and things like that to formulate. And they are conveying that in a structured way to you. That's what, all, education is. Well, not all education. There's education you can get from life and, life experiences and things like that. But, those are usually the ones that are a little more painful. So,
And they can be.
yes. All right, so let's jump into the news, because we got about 40 minutes where we're just going to talk general news, and then the last hour we're going to jump into a little bit more. There's been some developments with WLFI. We're going to talk about some exciting stuff that looks like is going on with ETH staking and it surging, and then we're going to touch a little bit on the Paris blockchain week that's going on right now, just because that is a big part of institutional adoption, is paying, and understanding how that's evolving, is watching, these, for all intents and purposes, institutional jack-off sessions, where governments and institutions get together and, talk about how they're going to take over the world, basically. So I've been going off this. I'm a little spicy. I've been going off this morning because tax season in the U.S. ended yesterday, and so all the politicians are posting about of course on the right, they're posting about the amazing tax returns that people are getting, and how we should be so grateful. And so I've been posting about that, saying like, oh, so if I steal your car and give you back the tires, you
I
should
know.
and then Elizabeth Warren's talking about, and of course, taxing the rich. And I'm like, okay, well, how about we do a quick history lesson about, how income tax came to be, where it was supposed to be a wealth tax only. And then that was judged unconstitutional. So by the Supreme Court. And so the government basically drafted the 16th Amendment to the Constitution, to where they made income tax for everybody and made it legal. Right. So, it's like whenever it just makes my skin crawl when they talk about, oh, it's only a tax for the upper 1%. It's like, yeah, that's how we got screwed the last time.
Yeah, man. Did you see what Mom Donnie posted coming out of New York?
Yeah,
that guy.
Like even part-time people that, like if you have a condo or or something in New York, and you don't even live there full time, that like he's going to tax the shit out of you.
Yeah. Yeah. Well, I mean, that's what happens when you elect a communist. Mm-hmm. So,
and you force out the tax base.
Yeah. I mean, I don't think people understand that socialism is just communism light.
Yeah.
And, New York is effing around and they're finding out. It's a real shame.
Yeah. Because I know the governor of the state is begging people to come back, that she was, basically laughing at because they were moving to Florida and Texas. She was saying, good, we don't need you. And
right.
then, fast forward a couple of years, you're like, oh, please come back.
Please come back, son.
Please, I'll change.
That's exactly what's going on, man.
Yeah.
Look, you can't push out your most productive citizens by taxing them.
There's a whole book
work.
on this. It's called Atlas Shrugs. Read it, and if you don't want to read it, there's a movie on it.
Yeah, and Ayn Rand, she has in Atlas Shrugged, there's a couple of pages, I think it's actually one page in there, where she describes the virtue of money. And you know how most people might talk about money as if it's the root of all evil? Well, there's a really, really great line in there. Let's see here, virtue of money passage.
Well, I'll tell you what I've found is money reveals the true character of a person. When somebody has money and power, it reveals who they truly are. If they have money and power and they're a good person, they are just a good person. If you thought they were a good person, they get money and power and they become a piece of shit, they were just a piece of shit.
Yeah, so there's a couple of things here from that passage, and I would really like to find the actual passage itself, because all I've been able to find so far, Mike, just using Gemini, is some key themes about the passage itself.
Well, let me jump into the news while you keep looking for that. Cut me off whenever you find it.
Cool.
All right. So TradFi and Macro. Oh, where'd he go? There you
Just
go.
grabbing some coffee.
Oh, okay, okay. Gas prices dip amid ceasefire. So the national average for gas dropped to $4.09 this morning following a 2 week ceasefire between the US and Iran. While crude oil is trading below $90 a barrel, supply remains tight as maritime traffic in the Strait of Hormuz is still subdued. So, not out of the woods yet, but light at the end of the tunnel. New York City's World Cup economic push. The New York City Council introduced a massive legislative package today to prepare for the 2026 FIFA World Cup. Estimates suggest that 3.3 billion economic impact, including a cultural passport program and naming Thierry Henry Way in Manhattan. I'm not sure what's going on with this. I'm not a big soccer person. I won't dive into that. Let's get into DeFi and crypto. So,
Okay. Kofefe.
yeah, I'm not a soccer person, so I'm not going to be able to speak intelligently on that. But it's going to be interesting to see how that pans out. With New York and the issues that they're having with tax revenue and things like that. It's going to be interesting, and crime in New York. I don't know exactly where they're going to, what stadium they're going to do the World Cup in, but with the crime and a lot of the stuff that's going on there, it'll be interesting to see how well that all goes.
Yeah, well, I don't know, but when I look around the world, Mike, and I see all of these different large cities, be it in the United States or in Europe, and look, you can watch video on the ground coming out of all of these places live in real time now, uncensored, thanks to X. So, the information is out there. The receipts are out there if you want to see them. But when I look around the world, especially in large cities, what I see is decay. And it's just a real shame because it's very easy now too to watch archival footage from those same cities,
Yeah.
from decades ago. And you can't tell me that things have improved.
No.
Yes, we've got all of this new technology, we have better healthcare, we have a better transportation. But when you look at the people and the way that they were living decades ago, and you compare that to the crime and the filth that we have now that seems to be spreading everywhere, it doesn't look like things have gotten better. It looks like things have degenerated.
We had one-income families in very nice suburban homes. You had clean schools that didn't have violence. You had clean streets that they had violence, but not like they do now. But people dressed appropriately. Men dressed in suits everywhere they went. Women dressed in dresses, and everyone. I remember as a kid going to the airport. This is back in the the 70s and 80s. I remember you dressed up when you went to the airport. I have pictures where I'm in like a little corduroy suit because my mom took me to the airport so I could fly to visit my dad, and that's just how people flew. Now people have pajamas on, and they're taking their shoes off and putting them up on the seats and stuff like that. And you got people freaking out and attacking people on planes. It's like things have not gotten better. I mean, you're 100% right, David.
Yeah, and I found that passage. Here. So this is from Ayn Rand's Atlas Shrugged.
Mhm.
And, I don't have the exact page here, but I do have the passages. So I'd like to read this. Run for your life from any man who tells you that money is evil. That sentence is the leper's bell of an approaching looter. So long as men live together on earth and need means to deal with one another, their only substitute, if they abandon money, is the muzzle of a gun. But money demands of you the highest virtues, if you wish to make it or to keep it. Men who have no courage, pride, or self-esteem, men who have no moral sense of their right to their money and are not willing to defend it as they defend their life, men who apologize for being rich, will not remain rich for long. They are the natural bait for the swarms of looters that stay under rocks for centuries, but come crawling out at the first smell of a man who begs to be forgiven for the guilt of owning wealth. They will hasten to relieve him of the guilt and of his life as he deserves. So that's just the first passage there, and it continues. But this is apropos for our time because you've got these looters. Mom Donnie is a great example. You've got, Elizabeth Warren, another great example. You've got most of the Congress
Gavin
people.
Newsom.
Gavin Newsom, another great example. Most of our Congress people, especially the ones like Biden, who like to, when he was a senator and when he was also president and vice president, who like to come out and say lines like, "I'll just pay your fair share." These people are the looters who will relieve you of
You
your
know,
wealth
you know what
and
the
your
fair
life.
share is? The fair share is zero.
That's exactly right.
None of us should be paying taxes.
That's exactly right.
That's the fair share. It's anything that has to be taken by force, which is what the government does. Don't kid yourself. It's under threat of force and violence. Basically they'll show up at your door if need be with guns and take your property and throw you in jail if you don't pay taxes. So don't fool yourself. We are being robbed.
Yeah, and look, it's not like you can't see this coming. We could see this coming from a mile away. And, Mike, I've been thinking about this for a while now. I think that most people are almost incapable now of thinking for themselves. It's just so much easier to go with, the hordes and just follow along than it is to be independent and think for yourself and, reject common wisdom because there is no wisdom in the herd. So, when I look around and I see cities decaying and I see politicians saying, "I'm going to take what little you have left by force," it just makes me think, man, we've lost our way. And that's why I think Bitcoin is so important. And crypto and DeFi and sovereignty. That's why we do this every day, because this
I
stuff
love
is
how you
so
looped us
important.
back.
Yeah.
Keep going. I love how you looped us back because me and you get on these rabbit trails and get political. But thank you for bringing it back.
But it's all the same thing.
It is.
It is. And this stuff, look, I mean, if you want to be free and no longer be a slave to this system, you have to, number one, take control of your mind. And number two, you got to take control of your money.
Yeah.
And that means not being a slave to some bank somewhere.
Yep.
So that's what we do here.
We teach self-sovereignty here. That's actually we need to incorporate that into our marketing. Is basically universal self-sovereignty. Not just financial, but lifestyle wise too, because the homesteading and things like that. So the 360 sovereignty.
Yeah.
Something like that. I don't know.
100%. No, I love it. I love it. It's super important. Like, that is the thing of our time.
Yeah.
This is the issue, sovereignty.
And all the people that I know that are thriving, even though things are tough right now, are people that have moved towards self-sovereignty, financial and, their food, their water, their shelter, all of that. The people that are self-sovereign are the ones that are kind of shoring up, while everyone else is hemorrhaging. So let's get into institutional prep phase. So a major survey by Nomura and Laser Digital released today reveals that 4 out of 5 institutional investors are planning to enter the crypto market in the next year. The focus is shifting heavily toward DeFi infrastructure as regulatory clarity improves. Are you seeing anything on this, David? I mean, I know that we've been watching RWAs on RWA.xyz and just that parabolic adoption, of tokenization. And you're seeing networks like Canton that are just getting massive traction, and others, as far as this institutional adoption and almost the financial 3.0 of where TradFi is upgrading with 2Ds to blockchain rails. So I mean, what are you seeing?
Well, number one, so who is Nomura? What is Nomura? Nomura is a Japanese financial giant, but they tend to specialize in certain types of financial products. Their digital asset subsidiary, Laser Digital, is the one that put out this survey, the 2026 Institutional Investor Survey on Digital Asset Investment Trends. That is a mouthful. But the key finding here was simply that we're going to see more institutional adoption of these digital assets in the coming years as big institutional players go from a 0% allocation to between a 2 to 5% allocation into digital assets just over the next 12 to 24 months. So the expectation is that we're going to see much, much more adoption like soon. So look, it's coming, and you got to ask yourself, what are these institutions going to be buying? Well, they're going to be buying Bitcoin, number one. They're also likely going to be buying some Ethereum too.
Mhm.
And you take a look down the list, it's difficult for me to see now institutions buy, much more than like Bitcoin and ETH, really. They have been buying, stuff like Solana and Hype and Morpho, and there are institutions who are buying other altcoins too. But Mike, this is something that we talk about all the time. You just need to make sure when you are analyzing whatever your favorite altcoin is, that protocol, the underlying business, has to make money, and they have to return those revenues to token holders in some way. So, yeah, I think that the era of institutional adoption is just about to really begin. And even though I may not agree with the language in that Genius and Clarity Act,
Mhm.
doesn't matter, because the institutions need that legal clarity to be able to start to really pile into these new assets in this new asset class. And it's just about to start. But here's the thing, though, there is still a cycle. Bitcoin still has a cycle for some reason.
Yeah.
And are we going to see that cycle break? That's a decent question to ask. Is that cycle going to break? And how would we know it? If the cycle did break, how would we know it? Unless we're just looking back in hindsight, it would be easy to spot. But what's a forward-looking indicator to help us determine if the cycle is going to break?
That's a rough one. I mean, really, the thing that because I've thought that it's kind of been decaying, and I personally, and I could be totally wrong, am using as a gauge the transition from a speculative market driven by retail to one of institutions, smart money, if you want to call it that, because they invest with a long-term mindset for the most part, especially with ETFs and things like that. And so just, with that massive adoption and liquidity that pours in, the deeper the liquidity, the less volatile. So I don't know if it will go away entirely, but I feel like it will flatten out. That we're just over time, we're not going to see the pullbacks, in the size that we've seen in the past. That over time you're going to see higher lows and lower highs. And it's going to slowly become like the stock market.
I think that that's a great point, because you can easily measure the volatility of Bitcoin, for example. And you can see that since the launch of those Bitcoin ETF products, Bitcoin's volatility has contracted significantly. And so that could be part of the reason why we didn't get euphoria on the upside this past bull. Wouldn't it be funny, Mike, if the reason why we didn't get the euphoria and the true parabolic run this past bull was because of those Bitcoin ETFs, because they dampened vol? So remember, volatility
Could
works
be.
it works to the upside and the downside. It works in
Yeah.
both directions. So if volatility was dampened, what that means is you should expect the
Well,
move.
But
Be
Bitcoin got,
smaller.
I mean, from the lows, Bitcoin got quite a pump. I mean, it went from like 16K to like 125. You know, that, I mean,
Right.
that's quite a bull run.
Right. But
Um,
it wasn't the 20x that we got in
oh no, no, no,
2021.
no. But I mean, but it was definitely a nice pump. And then we just never really saw ETH get any kind of real pump. And definitely, other than the ISO tokens, just because of the narrative, because most of those are the large caps, but they got a little bit of a pump. And then, like we talked about before, the Trump coin sucked a couple of $1 billion of liquidity out of the market, and then October 10th came along, and it was almost like watching a Tyson fight, and the opponent was alt season, and and Tyson was Trump in October 10th, and just gave it the 1-2 with the uppercut, and it was lights out.
Oh, dude, I was watching some of those Tyson fights the other night, just
Oh,
clips of them. He was a beast in the
dude.
ring. Oh my goodness. I would not want to fight that man. I can't even imagine it. I mean, imagine getting hit in the head with a couple of bricks like that.
Dude, I wouldn't want to get hit by him now, let
No.
alone like he would kill me in his prime.
Yeah. Yeah.
Yeah,
Yeah.
you know,
And
like
not an
not
understatement either.
yeah,
It's not even a knockout. Like that,
no,
that would be an execution.
yeah.
Yeah.
I mean, if you aren't a trained fighter that has conditioned your body to take hits like that, and you're just like an average person, and you get
Nope.
hit, he's going to give you like a freaking brain damage.
Yeah, you're gonna have a hematoma in
Yeah,
your brain, and
subdermal
yeah,
hematoma. Yeah,
yeah, it's not gonna be good. But Mike, about the volatility though, that's actually a really interesting point about the Bitcoin ETFs and how they dampened vol, and
yeah.
that could have actually been the reason why we didn't get the true parabolic move to the upside this past bull, and it could be a reason why we may not get real true depression on the downside during this current bear. And so, I'm just thinking to myself, what would be a good leading indicator to determine if things are starting to shift back to the upside, or are we about to see that next leg lower on the downside this
Mhm.
bear? That's the thought process. And you know, if volatility went from 70% in BTC to 40% as it
Mhm.
did after the launch of those Bitcoin ETF products, that would certainly explain why we didn't get the parabola. But it would also tell us that the downside should be much more limited during this current bear market. So that's just something to think about. So what type of target should we be thinking about during this bear? Maybe some of the people that have been calling for 30K, myself included, maybe we're wrong. Maybe that's a little bit too bearish.
I've been leaning towards 54. I definitely see. I mean, because you've laid it out very nicely to where the 30s is a possibility. It's very much a possibility. But my money is literally going to be in the 50s because I got some dry powder on the sides, a couple of grand on the side. That if we get into the 30s or the 50s, that a good portion of that is going to go into Bitcoin. And if we go into 30s, then the rest of it will go into Bitcoin. So,
Yeah. Yeah, no, I hear you, man, and I am going to be buying as much Bitcoin as I can get my hands on if it breaks below its 200-week moving average. That tends to be the great buy zone, that
mm,
200-week.
absolutely. All right. So it looks like, um, so yeah, we were talking about institutional investors, 4 out of 5, getting in this next year. Some 65% now see crypto as a di- why am I having such a hard time pronouncing words these days? Diversification tool, putting it alongside stocks, bonds, and commodities. To be sure, the bank warned that challenges still persist, including the lack of clear ways to value assets, ongoing volatility, and uncertainty around regulation. That is key. That is what David was talking about, where these institutions legally, they cannot, invest liquidity, their assets under management into these crypto products because there isn't the regulation in place. And that has to be in place for them to, full port, into some of these assets. So it looks like they quoted at the same time, adoption is accelerating due to the development of a diverse range of investment products, and improvements in risk management practices, regulatory reforms, and increased participation. DeFi yield. Institutional investors are pursuing cryptocurrency yield strategies rather than just token price appreciation. And this we are seeing on a massive scale. Institutions have gotten into protocols like Aerodrome and actually started doing locks. They've gotten into Morpho and they curate vaults, to generate yield. A lot of their baskets of assets, funds, for all intents and purposes, where they basically do what David talks about, where they, mitigate risk. So, they might be consist of private credit with bonds, and, and the bonds would be what is used to, kind of mitigate the risk of the private credit. Maybe a small portion is in certain stocks, like tech stocks or something like that. And so they structure these depending on risk tolerances, and people can basically invest in these basket of assets to get exposure to a wide range of assets to grow their portfolio either steadily over time or more aggressively, with added risk. So, what are your thoughts on that? What are you seeing, David?
Well, it's something that's important for me. And as you were speaking, Mike, I was putting together and am putting together now some research on volatility, Bitcoin's declining volatility. And so, as you were talking about, institutions, gaining exposure to these decentralized finance products on Morpho, different vaults that they're curating, RWAs coming on chain, as volatility contracts, it actually means that institutions can increase their position sizes, because as volatility drops, these funds, they can buy more while maintaining the same risk profile. So what this can lead to, if you're talking about an asset like Bitcoin, for example, is it can lead to this grinding price action where you get a slow, steady march either up or down, rather than really large spikes like the vertical moves to the upside that we saw in 2017 and 2021. But also you tend to get fewer crashes too. So as Bitcoin's volatility went from 70% to 40% after the launch of those Bitcoin ETF products, it essentially acted like a taming of this asset. Well, double-edged sword. And while it represents risk, it also can represent returns. So what that narrowing of the volatility did is the contraction of volatility narrowed the expected move. So the expected range that Bitcoin would trade within over a 12-month period at 70% vol, that means if Bitcoin's trading for 75K right now and it's got 70% vol, that means a normal yearly range is between 22,000 on the downside and 127,000 on the upside. But if volatility for that asset goes from 70% to 40%, then all of a sudden the range, the expected move, gets much smaller. So it goes from 22K to 127K to now the expected move is between 45K and 105K. So what that means you should expect as an investor is fewer of these moon missions, 10x gains, but also fewer catastrophic 80% drawdowns. So the contraction of volatility is really, I think, probably the best leading indicator for us to determine if maybe the cycle is going to change.
Yeah.
But it hasn't changed yet. So
well, really quick, David, what effect do you think, like Ambrose? We talked about it, just the other day, and we actually locked in the CEO of that project for an interview on the 30th, if memory serves, of this month. after the BTC conference. They have a huge announcement that he was talking about and wanted to wait to come on the show until that announcement came out. But what do you think that true Bitcoin native DeFi is going to do to volatility? Because that has kept, I feel, a lot of native Bitcoin very stagnant. That liquidity very stagnant because it's been, for the most part, a store of value and not necessarily a medium of exchange or an asset that you can earn yield on. I mean, you can, but just in very small amounts. I mean, the most I've seen is maybe 1%, 2% at best. But with what Ambrose is building with RailsX, and there's others out there on Lightning, it seems like that there is a movement that is building to unleash that liquidity and potentially bring volatility back. I mean, what's your thoughts on that?
Yeah, so Amboss, and their Rails X product, they've built an entire stack. And what's so interesting about that is the ability for end users to operate on Bitcoin Lightning, like in DeFi on Bitcoin Lightning.
Yeah.
So what impact will that have on the volatility of Bitcoin? Well, I think it turns Bitcoin from a passive asset into a productive asset. When you can suddenly, earn yield on your Bitcoin of between 4 and 6%, well, then there's an opportunity cost for you to sell that Bitcoin. Because if you're able to earn yield and look, that is just a huge net positive for BTC. It creates like a yield buffer. But it also potentially introduces leverage. So if you're trading Bitcoin with leverage on Lightning, well, then leverage introduces a lot of risk, right? We could see a new type of risk on Bitcoin, where just like on October 10th, we had the liquidation cascades on Binance and Hyperliquid. If there are very large exchanges that are built in the future on Bitcoin Lightning that enable users to trade using leverage, well, we might see liquidation cascades natively on Bitcoin, which could be
Bring volatility.
Yeah, it could see volatility expand as a result of that. So for me anyway, I think the real thing that's amazing about what Amboss is building and what other teams are building on top of Bitcoin and Bitcoin Lightning is the ability to use Bitcoin as a true productive treasury asset. So instead of denominating everything in dollars and living in this US treasury dominated system, you could use Bitcoin as your treasury asset. And that's really what I'm looking forward to, because that is true sovereignty right there.
Well, I mean, think about it. Which, and I think this is, not to toot my own horn, but I think this is kind of insightful. Is if you are looking for, an asset or somewhere to put liquidity, and your choices are a bond, a treasury bond, where you earn maybe 4%, and the underlying asset is the US dollar that's losing 7% due to inflation, or you can have Bitcoin and you can use DeFi to earn 4 to 6%, and it's going up in value over time. Which are you going to choose as an institution? If you have a legal obligation to your stockholders and to the individuals, your clients, if you're a licensed financial advisor and all of that, and you have a legal fiduciary obligation to your investors, which are you going to choose?
Yeah, well, you have no choice. You have to allocate to the asset that is going to generate returns for your clients. You're legally bound to do that.
Exactly.
If you're a fiduciary. So, for me, Mike, I really just like to think about, what is the likelihood that Bitcoin, achieves that new trough, or what is the likelihood that we rebound from here and shoot back up to all-time highs? And the only way that I can really think about that is through the lens of probability and statistics. And so as we go through and finish going through this news here, what I'm doing is putting together a piece of deep dive research on the
Perfect.
contraction of Bitcoin's volatility, so that
No,
we can then take a
absolutely.
look at that towards the end of the call.
Well, let's move on because we only got a couple minutes left before the last hour where we go into our deep dive. But this right here, Nakamura flagged currency pegged tokens as a key driver of growth, with 63% of respondents seeing real uses for stablecoins, including managing cash, making cross border payments, trading currencies, and investing in crypto and tokenized assets. And this is just a graph where they just show since 2018, where USDT, there was only $60 million worth just over time, of all these different stable coins and where they're at now, where, you have USDT is 183 billion. You have USDC with about 80 billion, and all these other, PYUSD, USD1, that's World Liberty Fi's stable coin, USDY, which is Ondo's stable coin, BIDL, which is BlackRock's. You have all these different stable coins now. JP Morgan Chase, they're launching their own stable coin. So stables are the basically foundation of DeFi. Without stables, that's how liquidity is onboarded basically into DeFi. So yeah, that's it can't understate, and that in a lot of cases can be a leading indicator
So
of how
this
the
is
markets
this
are
is
going.
great, Mike. This is a great chart. So here, if you pause on this chart for just a second,
Okay,
and if you take a look, the total size of this market, right? Let's call it 200 billion, just to keep the math simple, right? Let's call it 200 billion.
perfect.
Treasury Secretary Scott Bessent has famously said many times over the last couple of months that his expectation for this stablecoin market is that it grows from 200 billion to 2 trillion over the next 24 months. That is a very short period of time for this thing to 10x. So, if the expectation is that we see these stables 10x over the next 2 years, what does that mean for the digital asset space? Total market cap probably goes much, much, much higher, especially as volatility contracts. So, yeah, this is one of the core use cases for digital assets, is as a medium of exchange, the payment rails of the future and of the present. These are payment rails now, and if you want to start using them in your daily life, you can. You just have to learn how. So this stuff this stuff is coming, and going from 200 billion to 2 trillion, that's a big deal. I think most Americans are going to be using stables in one form or fashion over the next couple of years, and maybe even without realizing it in some cases. So
I,
adoption is coming.
honestly, I think that is 100% going to be the case, and they're going to be using DeFi in a lot of cases and not even know it.
Yeah.
Banks are starting to construct, if they don't have it already, they're starting to construct offerings for their clients to invest in these assets. I mean, they already have it where I think it was JP Morgan Chase is, well, anybody can do it now legally, is was it Freddie Mae and Freddie Mac are allowing Bitcoin backed home loans,
Right.
Ethereum and Bitcoin backed home loans. So it's not a matter of if, it's a matter of when, and it's what we've been saying here for years now, is that's why we stress so much that you need to become knowledgeable about these things, because early adopters are the ones that benefit the most because you're taking the most risk. People that bought Bitcoin back when I and many were laughing at them. I mean, I've told this story many times where my buddy told me about Bitcoin in 2011 after my last deployment, and I laughed at him. And he invested $100. And last time I talked to him a couple of years ago about that instance, unfortunately, his is locked on a hard drive that he lost the keys to. But when we talked a couple of years ago, he's like, "Yeah, that $100 turned into 500 grand, but I lost the keys to it, and so it's in a hard drive in my safe." And
Oh man.
that's a story that a lot of people that had happened to a lot of people, but those early adopters are took the largest amount of risk and they got the most reward. So, just like buying, Tesla, or buying, some of these stocks. If you bought Microsoft back when people were like, computers, it's a fad. I remember when people were saying, computers are just a fad, and the internet was just a fad, and these things became a major part of the world today, and people that saw the potential and invested at those times did very well for themselves. So
I think we're still early. I think we're
yeah,
still very, very early because this new technology is finding its product market fit as we speak. And we're starting to see that obviously there is product market fit when it comes to stablecoins. The use case for stables is clear. But you know what? We haven't quite seen, and this is just my opinion, we haven't quite seen real, true product market fit for Bitcoin yet, because I think Bitcoin's real product market fit is to become the treasury asset for the world. We see now the US Treasury system starting to have to compete with BRICS. Okay, so you've got half of the world in this new BRICS system, and then you've got the US Treasury system. And there's a parallel system here that I think is being built in front of our eyes as we speak. And that is Bitcoin, DeFi on Bitcoin, where you use Bitcoin as the treasury asset, not some, well, what are the BRICS? What was the BRICS money called again?
it was called the unit.
The unit.
G unit.
G unit. Like what?
G unit.
Oh my goodness. So you got the treasury asset, the dollar, and
Yeah.
then you got the unit backed
Yeah.
by like, a bunch of
Well,
dog
it was 40% gold, 60% a basket of
shit.
member
A basket of shit.
fiat
Yeah.
currencies, which
Yeah.
is like the Chinese yuan. The best ones would probably be the Chinese yuan, maybe the Russian ruble, but like the South African kroner or something like
Rand,
that.
the Rand.
Yeah,
Yeah.
the rand, and then you got India's rupee. You got Vietnam and Thailand, and basically a bunch of currencies that I would want to back something with.
I mean, that's a filthy, filthy fiat bag of doo-doo.
Dude,
Yeah.
that's a $5 crack hoe right there.
It's,
I
that
would
is
I wouldn't touch the unit with your unit.
no way, man. You couldn't pay me to do that. I'm just thinking about this though. Like we've got this treasury system. Now we've got this unit system,
Yeah.
but there's a third option here that's being built out. It's the Bitcoin treasury system.
Yeah.
And in order for Bitcoin to be a treasury asset, it needs to be productive. And that means we need DeFi on Bitcoin. And we're just now starting to see that get built out. So, last cycle, there wasn't true DeFi on Bitcoin. I
No.
think during this next bull, there will be. And so for me, Mike, I just want to own as much Bitcoin as possible.
Well,
That's it.
think about what a lot of these institutions are going to do with their, if they have, ETFs that are backed with actual Bitcoin. What do you think they're going to do with all of that Bitcoin? If they can, if they can earn 4 to 6% on it,
They're going to put it to
on
work.
Bitcoin DeFi, I mean, there's going to be a massive inflow of liquidity.
Because there has to be.
Yeah, institutional DeFi on natively on Bitcoin layer 2s like Lightning.
So, Mike, remember we were talking about a fiduciary duty earlier in the call? Like, dude, if these large institutions are sitting on hundreds of thousands of BTC and earning nothing on it, and then an opportunity comes along where they can take no additional risk and still be able to and start to be able to earn yield, well, they have a responsibility to their to their clients, to their stakeholders, to go ahead and get that yield. So I think that we could see like a massive explosion of maybe Bitcoin layer 2s or DeFi on existing layer twos, like Lightning, for example. But there are other Bitcoin layer twos. Lightning is not the only game in town any longer.
Oh, yeah.
Yeah.
So here's some stats real quick that I looked up. Institutional and corporate adoption, strategic reserves. Following the U.S. lead in 2025, public companies have significantly increased their holdings. Over 172 publicly traded companies now hold Bitcoin, collectively owning roughly 8% of the total supply. And that's Strategy and everybody else. The ETF effect. US spot Bitcoin ETFs now manage over 128 billion in assets, accounting for approximately 5.2% of the total circulating BTC supply. Corporate treasuries. A 2026 survey found that 25% of corporate treasurers are now interested in tokenized money market funds, MMFs, and 19% are interested in using stablecoins for operations.
Yeah.
So this is showing how early we are.
Yeah.
If you look at on the retail side, just a couple of examples. In the United States, in 2026, there's roughly 15.6% of people in the U.S. own or invested in crypto of some kind. So that's only we'll just say round up 16%. That's
not
nothing.
very many. That's not very many. And,
then,
yeah, I think that adoption is the big thing now. That will probably be the, not just central bank liquidity, but I think it'll also be adoption. Like when more people are onboarded, that should make these networks more valuable over time. And that should mean number go up.
But that's with tech, with any tech, with any, anything like that, any software, adoption is what makes it valuable. Facebook, people getting on Facebook and adopting it is, what gave it value. Google, Microsoft, just all these different, things. This, Amazon. It's all about usage. It's whatever people are using, whatever people are adopting. The iPhone, whatever the best tech is, and that gets adopted is what is going to be valuable. So
100%.
That's what we teach here is, we're trying to teach people, not necessarily spoon feed them the projects to invest in, but how to assess a project and, go through, do your deep research on it and figure out, one, is it solving a pain point, or a problem, for either institutions or retail or something like that. So that, there's value to the product or service. Are they generating revenue, which is key? It's something that we haven't done in the speculative market. People just invested in whatever token that they thought was going to get pumped next. Didn't matter what the company was doing because most of it's vaporware.
Right.
So, is it actually generating revenue? And then, like David mentioned earlier, is there something in the tokenomics or the mechanics of the project that gives a way for those profits or revenue to make their way to token holders in some way? Because if there isn't, it doesn't matter how successful the company is. You're holding a meme coin.
Right. And, one of my favorite, maybe not an analyst, but one of my favorite guys to watch is Arthur Hayes. Arthur Hayes, a Bitcoin billionaire, and, it famously created perps, that funding rate mechanism. He was one of the creators of that over at MEXC. And what he likes to say is, where the hell's my money, right? If I'm holding a token and the revenues and the protocol's generating revenue, well, where the hell's my dividend? Where's my money?
Anytime people say that, it's like I think of that J.G. Wentworth.
Yes.
It's my money. I need it now.
It's my money. I need it now. Yeah, look, if the protocol's making money, they need to return that to token holders. And if they're not doing that, then you're basically holding either some type of a meme coin or some type of governance token. Then honestly,
it's worthless.
Who wants to own a governance token? I certainly don't. I want cash. Pay me.
I want to earn yield. I'm here to make money.
Exactly. So, speaking of making money, let's talk a little bit about volatility and how volatility for Bitcoin has compressed in the post ETF era, and how that volatility compression, it could have actually been that the Bitcoin ETFs themselves were responsible for, Bitcoin not experiencing a parabola on the upside this past bull cycle, because hey, that's what the math says. So let's dive into this slide deck, Mike, and then I've got a piece of video content on the way that we'll be able to go and take a look at. Okay, so number one, the volatility collapse. So we saw volatility go from roughly 70%, its historical mean for Bitcoin, to roughly a steady 40%. So what this did after those Bitcoin ETF products were launched was it repriced Bitcoin's risk profile. It made it less risky to hold Bitcoin because it doesn't have the same level of volatility that it had just prior to the launch of those ETFs. So that is really, really interesting here. Let's go ahead and move on to the next slide. Okay, so this is the regime shift from speculative reflexivity to institutional equilibrium in the post-ETF era. So before the ETFs, the marginal buyer was retail, leveraged retail speculators, often trading with 50 or 100x leverage, which, it's like, sure, normal. Like,
oh,
totally,
it was a thing,
totally normal.
Basically, it was a casino.
Yeah, well, I mean, why not 1000x leverage? I mean, fuck it.
Oh yeah, no, if you're gonna hose yourself, go big, go home, go big or go home.
Okay, so that was the marginal buyer before the ETFs. Now, the price mechanics before the ETFs was this reflexive fear of missing out loop that led
The
to
emotional loop.
exactly, and it led to these blow off tops, but it also led to this catastrophic deleveraging. Those were the crashes. So the marginal buyer was levered retail. The price mechanics were reflexive FOMO. And the market cycle was dictated by this minor reward halving cycle. And, here's the thing, is that cycle going to continue? That's the question here. Or is it going to continue, but the price moves are going to become smaller on the upside and the downside? So that was the pre-ETF era. Now we are in the post-ETF era, where the marginal buyer is institutional asset allocators, sovereign treasuries, digital asset treasury corporations. So if you take a look at who actually holds the Bitcoin, like it's mostly starting to become institutions at this point. So if you take a look at, a guy like Saylor, how many Bitcoin does he have now, Mike? Is it 800,000 or something like that?
It's over 800,000. I'll look it up.
Yeah, so he's got 800K. I think that other there are digital asset treasury corporations that hold significant Bitcoin. There's, all of the Bitcoin ETF products themselves are holding a significant amount of Bitcoin. So, the marginal buyer now is institutions.
Roughly 781,000 Bitcoin, totaling about $60 billion.
I mean, amazing. It's great. It's great to see that. So the marginal buyer has changed from levered retail to institutional asset allocators. And that has changed the price mechanics. So it went from this reflexive FOMO loop to professional arbitrage, where you've got this, sticky spot capital where they're going to buy Bitcoin and then they're going to get short futures against it. So that creates a delta neutral position and they're able to earn funding on those futures or whatever the basis is. And then now what's the market cycle, right? So are we still in this quadrennial minor reward halving cycle? Is that what we're still in? Or is the market cycle, is it changing? And is it now going to be driven by macro liquidity and global debt refinancing, as many people have speculated? Are we seeing right now, as we speak, the changing of the cycle? Well, here's the thing, Mike. Whenever anyone says this time it's different, it just makes me think, yeah, I don't know. I don't know about that. you know,
Well,
so
it really is funny watching a lot of and that's why I don't call us influencers. Yeah, it's really funny because influencers they flow with the narrative. Whatever the narrative is, whatever's going to get them views, whatever's going to get people to click, things like that. That's an influencer. When you just speak the truth, no matter what the markets are doing, then I don't see that as an influencer, and that's what we try to do here. But that's what we were seeing is you saw everybody talking about this potential for a super cycle, or like all these different kind of buzzwords and catchphrases that this time was going to be different. And those things could have happened, absolutely, but it was the prevailing narrative that we were going into a super cycle, and then everything tanked. So
yeah, yeah. And so this chart right here, although it might look intimidating to some, this is, I think, one of the best ways to understand the changing of the guard when it comes to Bitcoin's volatility regime, going from 70% Bitcoin volatility to 40% Bitcoin volatility. This has effectively acted like a clipping of the wings of Bitcoin's probability density function. Now, what in the world does all that mean? Well,
please.
yes, when you've got 70% vol for an asset, that means that the expected move up or down is much greater than when that volatility compresses to 40%. It means that the expected move becomes much narrower. And so what's happened for Bitcoin is that it still retains much of its upside convexity. That simply means that you can experience runaway moves on the upside. But because the volatility has compressed from 70% to 40%, that means that you've eradicated a lot of these really severe tail risks. Think the 80% drawdown. Those 80% drawdowns should likely not occur ever again for Bitcoin.
Well, and institutions, like it's saying in the material there, that's really what prevented institutions from wanting to invest in it. They don't want that volatility because, again, they have a fiduciary responsibility or a legal obligation to their investors to ensure a slow, steady growth, or at least a growth with as minimal downside as possible.
Right. So basically what's happened is as volatility for Bitcoin has compressed, we're unlikely to see those severe drawdowns during a bear market of between 70 and 80% any longer. So it's just statistically very unlikely that an asset with 40% volatility would experience an 80% drawdown. So that's what these institutional asset allocators need in order to be able to allocate more to BTC. So here's the new normal, right? So if Bitcoin's spot price right now is 74K, I produced this research a couple minutes ago. So, that was when the spot was 74.5. And let's say the risk-free rate that's the US Treasury rate of return, 4.3%. So what is the new normal for BTC? Well, a 1 sigma move, this is a 1 standard deviation move over a 12-month period in the new normal 40% volatility regime for Bitcoin, means that its floor is likely around 50K and its ceiling is likely around 111K. Now, think out over a 24-month period of time. That means we could still see that upside convexity where Bitcoin rips up to 166. And, funnily enough here, Mike, 166 is where there is some resistance for Bitcoin on the upside. I just find that to be
just using like a Fibonacci scale, or
no, just like basic caveman type technical analysis. Like if we hop on over here to a chart of BTC just to share this real quick, let me go ahead and remove this Fibonacci stuff here, and I can remove this vertical line also. We've got these two bear flag patterns still for BTC. This is a weekly, but if we just zoom out so that we can see all of this, there we go. Let me grab this arrow. So if I use the
Oh, that trend
2017,
line. Gotcha.
that's all it is. That's all
Yeah.
it is. It's a super, super basic TA. So here's the anchor. I connect this to the next higher high, extend to the right. This predicted the all-time highs for Bitcoin this past bull, but it could also predict the next peak up here in 2029 around 170K. And, it's just so funny because that's what the statistics tell us to expect also is over a 24-month period, a ceiling around 170. That's where the TA says that we should see resistance also. And the 12-month floor around 50K, if we just check in with the chart real quick, the 200-week moving average comes in at 59, let's call it 60K right now. That is an important level of support. But if that were to fail, then the next level of support is right around here. That 2024 low, that's right around 49K. So 49, let's call it 50K. That aligns with what the statistics say too. 49K 12-month floor and 170K 24-month ceiling. So this is really, really interesting. So what's happened as volatility has compressed is you've got this tail risk reduction. So notice in the 70% volatility regime, a 3 sigma event, that's a 3 standard deviation event, that implied a 90% plus collapse in price. But as volatility has compressed into the 40% regime, the downside is significantly constrained. So you don't have those same types of drawdowns anymore. And so it establishes this 12-month support floor, $12,000 or $13,000 higher than historical models projected because volatility has compressed for BTC. That means the expected moves become more narrow. That means we likely don't get the big rips on the upside. We don't get the 3 sigma moves on the upside where Bitcoin rips from 74K up to 300K. You see the 24-month ceiling? That's 70% vol. So it means that when we have lower volatility, we are much, much less likely to see a 3 standard deviation or a 3 sigma move over a 24-month period up to $300,000. So that just tells me that, hey, whenever I see price predictions for Bitcoin where people are talking about, Bitcoin, this next bull is going to be $500,000. Well, the math doesn't math. Like it doesn't make sense that Bitcoin would rip to 500K because the statistics say that is unlikely. Now in the event of some type of crisis in confidence of the dollar, maybe you would see something like that. But in the absence of that, then a 300K BTC price over the next 24 months is very unlikely, statistically very unlikely. Okay, so value at risk. All this means is with a 43% reduction in volatility, it means that institutions can buy significantly more. So when volatility is reduced for an asset, especially a nascent asset class like crypto and Bitcoin, as volatility declines, institutions can buy more. They can increase their size and still keep their risk profiles the same.
Well, and also like we were talking about before, imagine when native Bitcoin DeFi fully becomes a reality at an institutional level, and they're able to hedge, and they further reduce their risk. I mean, is that going to allow them to invest more heavily?
Yes. Yep. 100%.
Perfect.
100%. Yep. So this is exactly what you want to see if you're a long-term BTC holder. Now, The volatility-induced demand paradox. So this is, again, what I was just talking about. These risk parity funds, these are structural asset allocators, institutional asset allocators. And in the 70% Bitcoin volatility era, they were only able to allocate a relatively small 1.4% to Bitcoin. But as volatility has compressed, that allocation has significantly increased, a 78% notional expansion from 1.4% Bitcoin allocation to 2.5% Bitcoin allocation. Now, what happens if that 2.5% Bitcoin allocation goes to 5%? And Bitcoin's volatility continues to compress, which is what the expectation is, that Bitcoin's vol eventually goes from 40% to 30%, and then all of a sudden it's sitting right around what the S&P's volatility is, maybe at 15% some point in the future.
And then again, add in the DeFi hedge.
Right. Add in the DeFi. You really have to be thinking about that. So let me just read this core insight. So these institutional risk parity funds, these strategies allocate capital based on the inverse of volatility. So as an asset becomes less volatile, they allocate more. So paradoxically, the more stable Bitcoin becomes, the more of it institutions are mathematically mandated to buy. So this creates this, right? Isn't that
That's what
cool?
happens with what happened with treasury bonds and things like that, and why banks and institutions historically have invested so heavily in them.
You really, I think, Mike, we need to start thinking about Bitcoin as a treasury asset.
Yeah,
That's what it is. It's a
it
treasury
looks like
asset.
that's where it's headed for sure.
Well, that's exactly what it is, I think. So this is interesting. So the price dampening mechanics of sticky capital. So pre-ETF retail using 50x leverage to trade to Bitcoin, and you get this forced deleveraging and margin calls. So you get,
Mhm.
the FOMO, the leverage.
Liquidations and
Yeah, you get all the FOMO on the way up, and then you get the deleveraging and liquidations on the way down. So, but now with these ETF products and big players like Michael Saylor and Strategy,
Mhm.
all of this supply is getting absorbed. So
and
these,
and they're holding it spot.
right, right, they're holding its spot. It's one for one backed, and this circulating supply is getting absorbed. So let's take a look at the stress test proof. So during that late 2025 market correction, we've seen this drawdown from the all-time high, but only 13% of cumulative ETF flows exited. So these one-for-one spot-backed vehicles absorbed volatility rather than amplifying it. So remember, there was all this conjecture about the ETF products potentially enhancing volatility on the way down. We
I
haven't seen
I
that.
I mean, I heard that, but I didn't see how that was a possibility. Because I mean, historically, there was always that liquidity rotation that everyone talked about, where people invested in Bitcoin first, it pumped, and then people would, basically FOMO into ETH, whenever they saw that it was starting to move, and then they would ride that up, and then they would, flow out into large caps, and then they'd, flow out into altcoins, and then finally memes. And that's kind of how the liquidity flow went to try to maximize profits, and it was just rinse and repeat. And then you went
Right.
into a bear market because, you got up to that euphoria where people are buying, pictures of rocks and, all that kind of,
But Mike, I bought a picture of a left hand facing rock. And
well,
so, you
that's
know,
why you paid 1.5 million and not just 1 million. So, but that's historically how it went. That's how most people made their money in, and that's why this last one was kind of such a shock to everybody. Is we got Bitcoin pumped, we got select altcoins that did a little bit of a pump. ETH never really got a significant pump, and then everything went to shit. And so everybody was like, "What the hell?"
yeah.
The cycle's not broken necessarily, but a lot of the historical flow of liquidity, it didn't it didn't follow the same pattern. So
Well, yeah, because we're in a different era. You
yeah,
know,
we're moving from
those
speculative market to a utility market.
right, those pre-ETF retail driven pumps
Hmm.
and deleveraging events, it could anyway be a thing of the past. Now that we have these ETF products scooping up, a scoopy, just buying a lot of spot BTC, it's dampening vol. It's really dampening vol,
Yeah.
and it's we're not seeing more volatility on the downside. In fact, we're seeing significantly less.
Well,
So
just
just
to simplify it for everyone. I mean, not that people don't understand this, but just in case it's kind of missing the mark with some people. Basically, what we're saying is this Bitcoin that traditionally, like I was talking about, was sold after Bitcoin pumped to go into ETH and all these other things. It's just being held. It's not rotating. That liquidity isn't rotating. It's staying in Bitcoin. So that makes it to where it's not being dumped. And if it's not being dumped, that's not dumping the price, which again decreases volatility. So and then on the upside, they're just continually buying. A strategy just keeps buying. A lot of these ETFs, a lot of people keep buying. David always brings up the one website where it shows ETF inflows and outflows. Net, it's in the positive. There's much more inflows than outflows over all of the over time. So yes, there's days where there's more outflows and days where there's inflows, but net overall it's positive inflows. So go ahead.
so check this out, Mike. It's if we're talking about flows, well, then I think we probably need to talk about the depth of the market. How deep is the Bitcoin order book? Well, it has definitely become, much, much, much deeper with all this liquidity on these large centralized exchanges. So think Binance, Coinbase, Kraken. The depth of these order books is now measured in hundreds of millions. So plus or minus 2%, these mid prices, we've got these really, really deep order books now. So professional market makers dominate volume in this market now. And so the massive volume of limit orders within 2% of the mid price, what it does is it structurally caps blow off tops. That's a lack of sell depth on the way up. And it caps capitulation bottoms. That's a lack of buy depth on the way down. So it ensures that you get execution efficiency and much, much less slippage. But it also means that the size of the moves is usually smaller now. So we don't have like, a 20% move in a single session any longer. Not as often anyway. So let's see here. What else do we have in this? Oh, okay. Demise of the 4-year minor cycle. So this is the thing to think about, really, I
I
think.
Real quick, I've actually seen a bunch of news about this where a lot of miners are shifting over into AI.
Yeah, I've seen that too. We could just take a look at Bitmine.
Mhm.
The Bitmine's a great example. That was a Bitcoin miner
Yeah.
and, pivoted to become basically just an institutional Ethereum staker. So that's an interesting pivot, no doubt. Let's just read through this here. So it says the profit to volatility ratio has remained above 0.015 since late 2023, the longest sustained period of stability in the asset's history. So I'm just really, curious what even is this? So cycle amplitude and profit to volatility ratio. So here's the insight it says price behavior is no longer dictated by the quadrennial supply reduction. So that's the every 4 years or so, we have the miners, there's the halving event, and their rewards for, solving transactions. The rewards get cut in half. So it says the market has shifted from violent retail boom and bust cycles to a methodical institutional grind higher, driven by macro liquidity flows. So basically, what this research is saying is the miners don't drive the price as much anymore. The cycle doesn't drive price as much anymore. That's really interesting. Really interesting. So let's see, leading global liquidity. So this is something else that, remember how many times, Mike, at the beginning of the cycle, people would throw out that chart of M2
I,
money
I was just
supply,
I was just about to say, yeah.
right?
Everyone was always talking about the how basically Bitcoin moved with the M2 money supply, and yeah,
Yeah. Yeah. So, I mean, that correlation has definitely broken down, but it's saying here that the correlation with the global easing breadth index tracking 41 central banks has shifted from a positive 0.21, so a positive correlation in the pre ETF era, to a very negative correlation as of early 2026. That's just so interesting to me. So it says the insight is that Bitcoin has evolved from a macro lagging receiver to a leading pricer. So institutions build positions 6 to 12 months ahead of central bank pivots. By the time a rate cut is announced, liquidity expansion is already priced in. Wow, amazing. And so what have we been, looking forward to for so long from the Fed, right? Everyone was talking about, oh, I want some more cowbell.
yeah,
When's the next rate cut, right?
yeah.
Well, if we just hop on over here to Fed Watch just real quick and take a look, currently the Fed funds rate sitting at 350 basis points to 375 basis points. That's the current Fed funds rate. There's actually a non-zero probability of a hike at the next meeting, which is in 13 days' time. So, that's the next meeting. But if we just take a look at the aggregated chart here, so what we're looking at is over the next, what is this? Over the next couple of months here, the next couple of meetings into December of 2027, what is the market pricing? What are the meeting probabilities for, rate cuts or rate hikes over the next couple of months here? Well, the market is basically pricing no more cuts. Basically, no more cuts until maybe March or April of next year. Okay. Now, this stuff can change on a dime. And what would be required for market participants to start pricing in cuts again? And that would mean, more central bank intervention in the form of, I mean, look, let's face it, they've got one tool, and that tool is more. Just print, print, print.
Yeah.
What would force them to really start to print, print, print? Well, something would have to break. Something would have to blow up. And if we take a look over here at the S&P, with the S&P having just basically gone vertical, for the last 3 weeks, it doesn't look as though anything is likely to be blowing up anytime soon. And so that means that rates themselves are likely to move a little bit lower now. So we shall see what happens to the dollar as a result of rates potentially moving a little bit lower, but the dollar is sitting at long-term support. So if this flag confirms and the dollar breaks down as rates move a little bit lower with the S&P at fresh all-time highs, that doesn't exactly tell me that we're about to see more rate cuts. And so if we bring it back to the presentation, if Bitcoin is a leading macro receiver or a leading pricer, then hey, you know what? You need to be thinking 12 months out. So if we need to be thinking 12 months out in order to build a position now, well, then when is the next cut going to be? When are we going to see more central bank intervention? Because as of right now, things look pretty good, right? S&P at fresh all-time highs. All of the big tech items have recovered. The SMH is at or near fresh all-time highs. So things look pretty good. It looks like maybe we're getting a resolution to this conflict in Iran, a positive resolution, and markets look pretty happy right now. But markets are forward looking. And so if we are digital asset investors and we're thinking about buying Bitcoin, and we know that Bitcoin is now a leading pricer of central bank intervention, well, then we need to be thinking about buying Bitcoin when things look calm, so that when there is that next set of interventionist policies by central banks, and that starts to get priced in, we're already in the position. So we've got to be able to look forward a little bit. Okay, so forward projections. This is the debasement trade. So here's the macro backdrop. Sticky, 2.8% global core inflation, and a hawkish Fed pause is being offset by looming global sovereign debt refinancing. So what do we have a lot of in the United States, Mike? Got a lot of debt. I mean, that too, man. We got a lot of debt, We've got $40 trillion in debt.
Mm-hmm.
And a lot of that, under Janet Yellen, was, at the very front of the curve, very short-term paper, it's referred to as. And so that short-term debt has to be rolled. The Treasury has to refinance all that debt. So how are they going to do that? Well, the Secretary of the Treasury, Scott Bessent, is a brilliant manager, and so he's rolling all of that debt, but he's using the same front of the curve that Yellen used. So this sticky 2.8% inflation and the hawkish Fed pause, this is being offset by the debt refinancing cycle. So if we're thinking about the end of 2026 through the end of this year, if Bitcoin is going to rally through the end of this year, well, the catalyst could be a Digital Asset Market Clarity Act or ETF momentum. Now, I actually think that it's a little bit less likely that the Clarity Act becomes this, like a positive thing. I actually think that the Clarity Act could be negative, but it depends on what the language is in it. Now, here's the risk. If we have persistently high energy prices and a hawkish Fed that is forced to hike, well, then, because Bitcoin is this leading pricer of central bank intervention, if the Fed is hiking, I don't think Bitcoin would like that one bit. Now, if we look forward into the middle of 2027, and remember, if we take a look at market participant expectations into the middle of 2027 for rates, right here, March and April 2027, the middle, the spring of 2027, it starts to look like, hey, we start to get cuts again. So if there's more central bank intervention starting, let's say, 12 months from now, and we know that Bitcoin is a leading pricer of that intervention, well, then, hey, maybe this sovereign debt refinancing cycle and accommodative policy shift could push Bitcoin significantly higher. Now, the risk here, I mean, look, there's always going to be a war somewhere. So geopolitical escalation, that's always a risk, right? And then the quantum computing stuff, to me, I think of that as like not quite FUD, but I just don't quite, I don't think that it's the existential risk that so many people make it out to be. Okay, so annualized returns for Bitcoin, right? In the Bitcoin ETF era. So this is in the new era. The expected annualized return moving forward should be somewhere around 25%. Now compare that to the S&P at 14.5%, or gold at 8%, or bonds, they call this return-free risk at 2%. Take a look at the volatility of this asset class, though, and its Sharpe ratio. So,
but I mean, it's something that you have to keep in mind, with bonds or any of these is the underlying assets. And in the case of bonds and things like that, if it's backed by the dollar and the dollar is inflating by 7 to 10% per year, that 2% becomes a negative. If it say on the best side, say you get 10%, that's still freaking a negative 8%. So it's not a very good investment. So sorry, go ahead.
Yeah, no, I agree. And here I just want to pause this for a second so I can see. Okay, it's done. Awesome. So the video content is done. This is going to be interesting. So I do want to play through this, and then we can finish up that slide deck.
How long is it?
So this is 7 minutes and 25 seconds.
Oh, perfect. We got 15 minutes left, so we got time.
Awesome. So let's check this out. This will be great. All right.
If you
And just want to make sure, Mike, when I play it, can you hear it?
Yes.
If you still view Bitcoin as the chaotic asset of 2017 and 2021, your models are out of date. The 70% volatility era has ended. This dual axis line chart tracks Bitcoin's historical volatility. The erratic peaks from earlier cycles have plunged into a compressed channel of 40. This is the log normal
no.
probability density function. Institutional trading desks use this equation to map future price outcomes, relying heavily on this specific variable, sigma, or annualized volatility. In this framework, the variance of the underlying asset determines the width of the potential price range over a 12-month horizon. At 70% volatility, the distribution is highly skewed. It allowed for 300% parabolic rallies, but also set a -1 standard deviation downside floor at $37,039. That severe tail risk kept risk-averse sovereign treasuries out of the market. Watch what happens.
Okay, so I just want to speak to that point just real quick. So as Bitcoin's volatility has compressed and become smaller, it means that the expected move over a 12-month time frame has become much more narrow. And that has allowed institutions to increase their size in this new asset class significantly.
To the expected price range when the distribution is recalculated with a 40% volatility input. The entire curve narrows, concentrating the probability mass around the mean. This effectively clips the wings of the distribution, reducing the statistical probability of extreme tail events in either direction.
So do you see that, Mike? The way that, with 70% volatility, you have a much wider range of distribution function where, the price could be, down 80% or up 300%. But as volatility compresses from 70% to 40%, now all of a sudden your range goes from -80 to +300. And now all of a sudden your range is much, much, much more narrow. So the floor and the ceiling becomes more narrow. So this is what institutions needed to be able to really start to pile into this, in addition to the regulatory clarity that it looks like we're going to get pretty soon. So this is a big, big net positive for Bitcoin.
The support floor moves significantly higher. The new -1 sigma move is mathematically centered around $49,985. Institutional desks no longer view a price collapse as a standard operational risk. The math dictates that downside extensions are now constrained by the absorption capacity of institutional liquidity. This statistical recalibration directly impacts active portfolio management through value-at-risk modeling. This is the value-at-risk equation. It quantifies the required capital charge a firm must hold in reserve to cover potential losses over a specific time frame. Notice the direct linear relationship between sigma and the total VAR.
Okay, so sigma, this is your volatility metric here. And so as volatility increases, value at risk, they have to allocate less. So institutions will have less value at risk. Position sizing becomes smaller as sigma increases. If sigma decreases, value at risk can increase. So position sizing can become bigger when volatility becomes smaller.
When annualized volatility drops by 43%, it translates to a nearly 43% reduction in the capital an institution is required to lock up to hold the asset. This dynamic feeds directly into risk parity funds, which allocate capital based on the inverse of an asset's volatility.
Right.
If a risk parity fund targets a 1% risk budget from Bitcoin under a 70% volatility profile, it restricts the allocation to roughly 1.4% of the total portfolio. Under the 40% volatility regime, that exact same 1% risk budget permits an allocation of 2.5%. That is an 80% increase in the notional size of the position.
And it's only likely to continue to grow from here, from 2.5% to 5%.
Without taking on additional mathematically defined risk. This creates a persistent, mechanical loop volatility-induced demand. The more stable the asset becomes, the more capital institutions are mathematically mandated to deploy into it.
Do you hear that? The more stable an asset becomes, the more capital institutions are mandated to deploy into it. Fiduciaries have to generate returns for their clients, their stakeholders.
What physical market infrastructure prevents the volatility from spiking back to 70% during a period of macro panic?
The ETF products, that's what has been the volatility dampener for Bitcoin.
The answer lies in market depth, the volume of limit orders waiting on the books to absorb sudden buying or selling pressure. This table displays Q1 2026 market depth data. Binance shows a total 2% depth of $740 million, while Coinbase holds $565 million. These deep liquidity pools support the stabilization hypothesis. They allow large whale orders from institutions to execute smoothly, without triggering the violent price slippage that destabilized the retail era. A secondary stabilization mechanism exists within the structure of spot Bitcoin ETFs, acting as a mechanical speed bump for price action. This flowchart illustrates the ETF arbitrage cycle. High fail-to-deliver rates, or FTDs, act as an early warning signal for liquidity stress, showing a shortage of deliverable spot Bitcoin. When an FTD shortage occurs and the spread widens, professional trading desks step in. They buy spot Bitcoin and sell ETF shares to capture the difference, physically restoring the peg. This process naturally slows parabolic upside momentum. As liquidity thins, the cost for an issuer to source spot Bitcoin to create new ETF shares increases. On the downside, the ETF redemption process relies on highly sophisticated execution algorithms. This avoids the blind market selling into thin order books that caused historical flash crashes. The combination of billion-dollar order book depths and ETF arbitrage operates like a hydraulic dampener, continuously harvesting volatility and enforcing a strict, mean-reverting market structure. The structural changes of the 2024 to 2026 period mark the end of the retail-driven 4-year halving cycle. Price discovery is no longer dictated by internal minor issuance constraints. It has transitioned into a macro liquidity cycle, driven by global monetary policy. This chart overlays Bitcoin's price against the Global Easing Breadth Index, a composite tracking the policy direction of 41 global central banks. Prior to the ETF era, Bitcoin held a slight positive correlation of plus 0.21 to this index. By early 2026, according to Binance research, that correlation massively inverted, dropping to negative 0.778. This inversion indicates that the asset is no longer a lagging receiver that simply reacts to policy announcements after the fact. Major central banking players like the Federal Reserve set the baseline for this global liquidity flow. Simultaneously, regional economic divergence from institutions like the European Central Bank plays an equal role in shaping the broader monetary dynamic. Institutional allocators are building Bitcoin positions 6 to 12 months ahead of anticipated central bank rate cuts.
So, what did we see if we take a look at FedWatch? We saw that we're looking forward, maybe in 12 months' time, to the next Fed policy pivot. But, Mike, that could happen a lot sooner because we get a new Fed chair next month. Kevin Warsh, right? Isn't that his name?
I believe that
The
was
new the new Fed chair next month. So, and President Trump certainly wants rates to be much, much lower. So that policy pivot could happen a lot sooner than anticipated. We shall see.
By the time a central bank actually announces a pivot, the liquidity expansion is already priced into the market. This often makes Bitcoin appear to trade contrary to headline macroeconomic news. Bitcoin now acts as a leading pricer of global central bank liquidity. It identifies monetary debasement long before the effects reach traditional bond markets. While absolute returns have cooled, the actual efficiency of those returns has experienced a structural upgrade. This table displays 2026 asset class metrics, Sharpe and Sortino ratios. Bitcoin shows a 25.1% return against 48.2% volatility. The S&P 500 holds a higher Sharpe ratio of 0.80 due to low volatility. However, the Sharpe ratio penalizes all volatility equally, including upside gains. The Sortino ratio provides a more accurate measure of value because it only penalizes downside deviation. Bitcoin maintains a substantial relative premium with a Sortino ratio of 0.70.
Hmm.
The mathematics show that the asset's idiosyncratic risk remains heavily skewed toward upside returns.
That's important. So if you don't have the same level of volatility on the downside, but you've still got this upside convexity, that's why institutions continue to want to pile in, because the expectation is for outsized returns on the way up and much more constrained downside during bear markets.
This structural asymmetry, limited downside tail risk combined with upside convexity, is the profile allocators require as they navigate the sovereign debt refinancing wave of 2027.
Right. So if we've got $40 trillion in debt and something like 9 trillion of that needs to be rolled this year and into next year, that debt refinancing cycle could be the next thing that Bitcoin becomes correlated with or inversely correlated with in some way.
The retail casino of previous cycles has been replaced by a methodical, algorithmic grind higher for the modern quantitative allocator. The 40% regime provides the mathematical mandate for Bitcoin's permanent integration into the global financial architecture.
It sure does. What do you think of that, Mike? I thought that that was great.
I always love those because I mean, we talk through it first, and then we watch those videos, at the end part of the show, and it really just kind of ties it all together.
Yeah.
I really am digging the kind of the format that we've kind of settled into.
Me too, man. Me too. I thought that that piece of video content was really, really well put together. Look, for me, Bitcoin is the treasury asset of the future. And as its volatility has compressed, that has simply made it more attractive to hold.
Absolutely. Well, I mean, that kind of wraps up our time for today, our 2-hour show. But that is not all that the node has to offer today. So if you would like to join us later on, we have Jeff is actually going to be going, not live, but a pre-record on a deep dive on a new project and potentially talking about an airdrop. We also have at 1 p.m. Pacific, 4 p.m. Eastern, we have David that is doing his market wrap up, about 15, 20 minutes of TA, and then going to roll right into on the same show, doing live coaching with Ellie and, taking her through his one-on-one coaching program. And that is not all. We have a fourth show for the day. Tonight at 6 p.m. Pacific, 9 p.m. Eastern, we will have the Red Pill, where we are going to talk about incentives versus intentions, why men are winning by staying single and not getting married. And of course, that's a biased take. And not every man wants to be single and doesn't want to get married. There's those of us that would love to, if we found the right woman. But it's from our side of the spectrum, we are seeing a serious lack of wife and mother material, and so we're opting to just focus on ourselves. Work out, build businesses, be financially successful, and enjoy life, and until we're able to find that person. And so, still looking for single ladies who would be willing to come on the show tonight and give your side of the story, because I know that there's got to be another side, because you got a bunch of guys out there that are just looking to sleep around and use women, and so I'm sure there's a minefield that you're navigating. When I would love to hear that side of the story. So as always, here on the Node, we are not an echo chamber. We are all about giving the full story. Unbiased views on every topic. Not just finance and crypto projects, but also politics, religion, relationships, all of it. So, David, you got anything in closing?
No. I really had a good time today, Mike, just going through that content about Bitcoin, and going to get back at it tomorrow for the next the next show here, man. Yeah, all I'm going to do over the next couple of hours today is I'm going to finish those AI agents, bro. That's what I'm going to finish.
Loving it. Yeah, no, it's yeah, having those AIs where they just kind of put our social media on autopilot, that music channel eventually on autopilot, the finances, having a basically an automated CFO, just all the different aspects, having that newsletter, just all of it. Once we're firing on all cylinders, it's going to be awesome to just kind of watch it all come to fruition. But
oh yeah, we're close.
With that, let's we'll go ahead and cut this off, and that will give me about looks like about 2 hours to get a couple of things done, and then we'll jump in with the market wrap up and the live one-on-one coaching.
Sweet. See you then.
See you then. Till next time, Veteran Crypto out.